Work. Well, thanks very much for having us today. And we have a very diverse panel across the ETF industry and some old friends here too. So why don't we have a lot to talk about. So we're just going to kick off with some quick introductions. Dave, do you want to start?
Sure, yeah, thank you. This is testing.
I don't think it's on. Maybe share.
Hello.
You got a hot mic here? You can take
get it
that one
fixed.
for now. Hello, everybody. My name is Dave Sharp. I'm a senior ETF capital markets specialist at Vanguard for our ETF capital markets team, where we're really focused on the trading and liquidity of our ETFs, trying to make sure that we're creating the best experience for our clients when they're buying and selling our ETFs, keeping the spreads tight, keeping premium discount volatility low, keeping market impact as low as we can. It's really the focus for our team. The other thing that I have to say is when I have one of these mics in my hand, I always want to live out my dream of being a rig side announcer. So welcome to the fixed income panel.
Hard to follow. John Keller, I work at Morgan Stanley on our ETF platform. We launched ETFs for the first time in February of this year. Launched 6 ETFs in February. We just launched 5 more in October, so we have 11 ETFs. There will be more to come from us. You will see us under the names of our actually sub-managers, I guess, if you will. So we launched Calvert ETFs in February, and then in October we just launched Parametric and Eaton Vance ETFs. So you won't necessarily see Morgan Stanley ETFs. You'll see us under our sub-advisors. And before that, I worked at Market Access with Kat, and before that, I worked at State Street with Marcel.
Matt Kaufman. I'm the head of ETFs at Calamos. I've been in the ETF space for about 20 years. Just a little bit about Calamos. We were founded in 1977. Really big expertise in convertible bonds, alternatives, and options. And so hopefully we'll gain some insight into taking a 50-year-old mutual fund company and learning from what we're learning along the way. We've been in the ETF space about 10 months.
Hi, I'm Marcel Benjamin. I'm a fixed income strategist with State Street Global Advisors and the Spider family of ETFs. We've got 39 bond ETFs in the U.S., about 130 billion. And I interface with clients on a daily basis talking about the markets, ETF construction, differences between ETFs, and those types of topics.
Great. Thank you all. So I think we're going to start off, as every fixed income conversation is starting off with, zero interest rate policy is over. And so how is that new normal affecting asset allocation? Like, what role does fixed income play in that? And Marcel, I do still get the State Street research, and you just published a piece, and the title is called Bag the Ag. Are clients really moving away from benchmark?
Yeah, it's a great question. So basically, this year and in the last couple of years, we've seen a massive trend towards cash, first and foremost. And we've actually got $40 billion across our 2 T-bill ETFs. One of those is now the 5th largest bond ETF out there. But clients more and more are also looking towards deploying that cash and thinking about construction in core bonds. So the CIO at State Street Global Advisors, Lori Heinel, is calling for 100 basis points of cuts next year. We'll see if that transpires, but certainly T-bills aren't going to cut it once the Fed does start cutting if that happens. So we think you have to be mindful about core and satellite, and there's a few different asset classes that we're favoring now in some of our thought pieces. Certainly the ag, there are lots of ways to deconstruct the ag and reconstruct it, and specifically high yield is one asset class that we think has some good technicals around it. The market's been shrinking now for over 2 years, about $250 billion of shrinking, including the end of October when Ford was upgraded. That was 3% of the high yield index. And then we really also like agency mortgages as an asset class where we've had about 50 basis points of decline across the curve just in the past month, and you haven't seen the duration or convexity profile of the mortgage index really change at all. And that's very unusual. Typically when interest rates go down, you have negative convexity in mortgages and you underperform. So those are a couple ideas that you can express through our funds. I'll see if anyone else wants to add.
Yeah.
I'd be curious, maybe just by show of hands, does anybody think that the Fed is going to cut rates next year? Anybody? Okay, let's say it cut rates above 50 basis points. Anybody think that?
Marcel, you have to raise your hand.
Yeah, we should. I do too. I'm just curious. That's interesting. Thank you.
Yeah. No, of course. And it's a good question because, fixed income, the outlook isn't really clear right now, and it's been fairly volatile. So I'm curious, ETFs have been always considered index, right? So passive investing. But when you think about asset allocation and the new topics that are coming up, John, how is Morgan Stanley and you discussing, choosing an active or a passive product with an asset allocation?
Thanks, Dave. So we're predominantly an active manager. We just entered the market somewhat recently, as I said. I would think about active fixed income ETFs in kind of 3 stages. The first was the star manager phase. State Street had TOTL with Gunlock. There was BOND with Gross. You could say SRLN at State Street with GSO Blackstone. The loan fund was kind of starish. The next phase of active fixed income ETFs was cash, so zero interest rate environment. You had Mint, JPST took off like a rocket, ULST. That's sort of a special situation as well because cash is always more or less an active asset class. I don't know any 2 basis point money market funds out there. We think that this third phase that we're just starting to experience now is going to stick more, if you will. And that's really in core. So Marcel touched on it. Core, first off, the ag is a fairly easy benchmark to beat if we want to go, talk about benchmarks that you can beat. 70%, 80% treasuries and government exposure, probably going to grow just because of the deficits. 2, there are huge allocations in portfolios, and especially in model portfolios. So our take is model portfolios are growing. They're substantial already. They're growing in size. They're growing more quickly than the rest of the market. It's becoming an increasingly competitive space. You have, and then you have shops like Morningstar that will allow you to evaluate them versus one another. So you have a really large asset class, could be 20, 40, 60% of some of these model portfolios if they're conservative. A benchmark that's somewhat easy to beat, if you look at Fidelity's FBND, JCPB from JP Morgan, these are beating the benchmark by 80, 100 basis points a year. If you're a model portfolio and it's increasingly competitive space, it's going to be harder and harder to give 60, 80 basis points a year versus your competitors if they're moving to an active space or to an active fund. So we think that now we're actually on a footing where active fixed income ETFs starting in the core space are going to make more sense.
So we want to dive a little bit more into active versus ETF index a little bit later on, but David, all of us here want to retire. Vanguard is synonymous with retirement savings, and with fixed income and the moves that have happened over the past couple of years, how are you looking at this with the 60-40, decumulation, guaranteed income? Where does fixed income play a role in retirement now?
Yeah, so obviously 60-40 took a beating last year, right? So it's a lot of what we're talking about as we naturally, talk a bit about 60-40 in general at Vanguard, moderate risk portfolio. Last year was the worst year it's had since the Great Depression. So it's kind of tough to stand up here or sit up here and say 60-40 is where you want to be. But we still think there's some value to that in your portfolio and thinking about as a starting point, 60-40 for long-term retirement. I think, naturally you have to look at everybody's different risk tolerance, time frame, other investments, other considerations as it relates to your portfolio and how it fits. But from a Vanguard perspective, we still believe the 60-40 is a okay place to place assets for the long term. There was some mention, we were talking a little bit, as we were preparing for this of, what happens for, long-term retirees. We go into this kind of neutral growth phase, especially where inflation's been over the last few years. And naturally, as we see that, we do see the opportunity in some areas that, we still believe passive at the core does, have value, but naturally, some of the active, John mentioned core bond. We're going to have products in that space soon that does give some advantage there to kind of move and try to get a little bit better in real returns. Because from 2011 to 2021, the 60/40 portfolio returned about 11% or 8.7 in real return. So one bad year does not make a strategy bad, but I think you just have to take a little bit more attention in this environment. The correlations between equity and stocks were really strong last year. Naturally, they are not. They are supposed to be negatively correlated, which is why the 60/40 should work. We think that as inflation comes down, that negative correlation can come back, and 60/40 is a okay strategy for a number of investors, to prepare themselves for retirement. I think the one last thing I would say is almost a bigger concern is just how are clients invested? Are they invested? When we look at some of the stats out there, 25% of Americans don't have retirement assets. The average account for retirement accounts is only $65,000. And when you look at age demographics for 35-year-olds, the average account size is only $13,000. So I think when we think about getting the message out to clients to invest, we want to be careful not to scare them out of certain strategies or scare them away from investing because of one bad year, and really try to reinforce that long-term perspective.
Yeah, no, I agree. And Matt, you mentioned that Calamos is new to ETFs, but a well-established asset manager, diverse. How do you think about your firm's asset allocation decisions or views in how you're launching new products?
Yeah, I think for our ETF line, it's almost in reverse. We think about our ETF strategy and then work with the teams internally at Calamos that we feel like have that expertise. So I think in a mature, established mutual fund company, normally you would say, okay, what's my allocation strategy? Where's my edge? And then you bring funds out in the mutual fund world that meet that. I think in the ETF world, as it's still growing, we have to look again where the puck is going, see what could be built in the future, what may not have already been built, and then see if that fits anything that we have internally. So coming from normal ETF shops that are mostly focused on distribution and marketing, having stepped into a mutual fund company and just lifting up the stones and seeing what all is in-house, there's a tremendous amount of capabilities that are already established in-house. And so going into a mutual fund company and taking them to the ETF world is more about, to me, finding what our edge is, which in our space is convertibles, alternatives, options, derivatives products, and then going into the ETF land and saying what hasn't been built yet, and is there a pairing there?
So we want to talk about ETFs themselves, and a big topic for ETFs always, since even when I began in ETFs, has always been the underlying liquidity, and how do you measure liquidity for an ETF? The fixed income question in liquidity has been a very big question. We've hit over $2 trillion in assets in the U.S. in fixed income, which is fantastic. But I'm curious, has that liquidity question been solved, David?
Yeah, so I think the story in fixed income is always, the liquidity is always there until you need it, right? But one of the great things that the ETF solves for really is by providing those two layers of liquidity, and so much that occurs on that first layer in the secondary market, transacting between hands of different market participants. We usually see about 80 to 90% of all the volume stays in the secondary market. So the underlying liquidity becomes less of a factor as more assets are turning over in the secondary. And what we've seen is really incredible growth in the notional. I think flows usually are a hot story, where flows going, flows into equity versus fixed income, but a lot of that is just naturally the sentiment in the market. What I usually pay a little bit more attention to is what is the notional trading in fixed income ETFs relative to history or relative to equities. And when we look at it relative to equities, 10 years ago it was about 6% of all the volume was in fixed income ETFs. Now it's 13%. When we look at just how much is traded, last year was a record year for fixed income ETFs, where they traded about $6.3 trillion in the market. That's 400% more than it was just 5 years ago, 750% more than it was 10 years ago, and you can hardly compare to 15 years ago. So when you have that much activity taking place, it really helps the ETF act as a bit of a shock absorber and protect a bit of that underlying market and not really test the liquidity there. Naturally, in certain events, March 2020, I've repressed most of that month, but for what I do remember, it was quite a challenging market there. And obviously, there's the counterfactual of what happens in that time frame if Powell and the Fed doesn't step in, on March 20th to say that they're going to backstop credit. But I think it still showed, we saw secondary market ratios, or how much takes place in the secondary, go from that 80 to 90% average up to 95, 98% in some names. So it really showcased that ETF can act as that shock absorber and help mitigate some of the liquidity concerns. Are they gone as you go into certain areas? No, they're not gone, but I think it really does help, mitigate the challenges that you would find in the primary market.
Kat, if I could just add to that. So when we're thinking about liquidity, I think we start with SPY, a fund that trades $35 billion a day, has a very low ratio of block trades to secondary, has about half the bid ask of its peers, and then this developed ecosystem. And we try to port that over to something like J&K, which last month traded $4 billion in one day. Greater development of the options market there, the lending market, just this broader ecosystem around liquidity. So that's kind of the model for us as we're thinking about growing liquidity in our bond ETFs.
And Marissa, I would probably highlight just in that early October kind of volatility in high yield, the ETFs actually traded more than the underlying market for the first time, right? So, or the first time since December of 15. But that is, I think, a real testament to the ETF as a vehicle to realize your investment goals in a tool that provides great liquidity at really low cost.
So, Marcel, you speak to a lot of buy and hold investors, like insurance, pension funds. A liquid wrapper, like an ETF, it doesn't fit perfectly, but they're using them, and that part of the market is growing in terms of holdings. So why are they choosing an ETF?
Yeah, so I think it varies. There's always ALM, and there may be an argument for a buy and hold portfolio in ALM, but it turns out that the liabilities are not perfectly known, and sometimes they change. So it works to both use duration targeting and match your durations and use an ETF for that exposure. If you think about the insurance space, we're also seeing greater usage in the surplus accounts. So our preferred ETF has an NAIC 2 rating, and it's widely held by insurance companies because it has this high-grade tilt to the index and exposure. We're seeing insurers use loan ETF for that exposure, because obviously you can't just go out and buy a bunch of senior loans. And we're seeing greater adoption across other asset classes as well. Even something like agency mortgages, why not have that in one ticker, have that exposure without having to deal with pay downs and factors and all the operational headaches that come with that. So there's a number of different use cases for pensions and insurers to grow their usage of ETFs.
Yeah, I don't think ETFs weren't always NAIC rated either, right? That was only in the last 6 or 7 years that you could actually submit an ETF for an NAIC rating. So I think the more that ETF firms do that, the more that's going to drive liquidity to fixed income ETFs as well.
Yeah, it's true. And someone, I think it was Marcel, mentioned the ETF ecosystem, which a coined phrase about 2015, I think, and it's actually grown stronger and stronger. And what we're seeing in the fixed income market, mainly in credit, where it's very visible, you're starting to see lot size trading going down. That's typical of equity trading, not typical of fixed income trading. So, John, you were a trader. You're at Market Access, a trading platform. Is that the ETF effect in the market?
So this is Kat getting me to give a market access plug here.
I can do that. I can pitch it.
I'm kidding. I actually think it starts with the trading platforms. I think without the trading platforms, like Market Access, especially in credit, it doesn't matter what traders are trying to do. They have to have an electronic medium to exchange. I think the ETF came after that. So once the Market Access of the world took off, the Jane Streets and Flow traders discovered that they could trade large numbers of line items quickly and efficiently. And because they were basketing, they were trading smaller sizes. Quickly, they found that they could become, the market makers found that they could become liquidity providers on a platform like Market Access as opposed to a liquidity taker. So they essentially became dealers and started algo trading. And so now they were able to bid, if they knew an ETF or a bond was an ETF bond, they could bid a 1 million block size the same way that they could bid 5,000 lot size. And so we're seeing more and more retail moving onto these trading platforms because of the presence of the ETF ecosystem, I think, within the Market Access trade webs of the world.
Yeah, I'm a true believer of the ETF wrapper. I've been in the market for 20 plus years, and I've seen a lot of really positive impacts ETFs have had across the industry. But now in fixed income, it's really almost like a pivotal point. But liquidity is something in fixed income that's harder to measure. And Matt, how does your firm think about the measurement of liquidity when they're either using a product or launching a product? How do you think about ETF liquidity?
Yeah, I think one important takeaway from this conversation is just in the real world, if you look at the bid-ask spread of a LQD liquid bond ETF, corporate bond ETF, it's roughly a penny wide, and so that spread is typically a lot tighter than if you were to try to replicate that basket on your own. I think the average corporate bond, individual bond spreads are around 30 basis points, and so there you see the benefit that Dave, you're talking about of that two-factor liquidity pool that you can work from. I think where it could break down a little bit on the product development side is working with active portfolio managers who are used to being able to buy whatever the heck they want and dive into whatever pool they want because you're getting cash at the end of the day and deploying it in whatever way you feel. And then doing it inside an ETF where now you have a market making community that has creation unit sizes and has to hedge those positions. So we went through that exercise a few weeks ago. We're working on a product that had a fixed income sleeve, and I was talking to our PM, and I said, what do you want to own? And he said, I want to own treasuries, current mortgage backs, bank loans, actually as many bank loans as you let me own, and CLOs. I was like, okay, there's no way this is actually going to work. And so we went through the exercise, called around the street, talked to market makers, got the same response. So we ended up in a good spot, but we implemented a lot of what he wanted to with ETFs because the liquidity's there. It gets him to the right point, and we'll probably have some of your ETFs in our fund coming up.
So we started touching a little bit on the index versus, passive versus active discussion. And I think in fixed income, it's really an important discussion because, fixed income ETFs really led the way in active ETFs. I was taking a quick Bloomberg search, and there's over 1,200 ETFs in the U.S., equities and fixed income, that are deemed active, and it's almost $500 billion. So the market's really grown. But a lot of that has only come in the past 3 years. Like most of those assets have come in the past 3 years. So, what's changed?
I think it's some of it is what Matt was talking about is just PMs getting more comfortable with what they need to do to make it a product that is going to be liquid in the market, because that's really important naturally for any ETF is this expectation of liquidity. There's expectations of managing to taxes as best as you can. There's just certain things within the ETF that you expect to occur. So how do you fit it into that wrapper? And Jason was talking earlier about the active passive, in that earlier session on active about just what does it look like when you are going to be transparent, and how do you get comfortable with that as certain managers want to maybe hide their IP or be careful of front running in a portfolio. So I think there's just been an added comfort there that you can do certain things to not showcase as much, that you're often maybe putting the cart before the horse on the front running perspective because you can get out of positions in a single day, and then everyone's going to find out the next day that you're out of it. I think it'll be interesting to see how some of these funds, as they continue to scale up, how they confront some of those issues. But I just think it's, naturally all the easy index products, ideas are kind of gone. So if you're going to put yourself on the map and you're going to, compete against, some of the firms that we represent here, even, active is a place to do that, to show that you can achieve alpha in a portfolio and be able to beat the managers, beat the benchmarks as a manager. I think it's just encouraging, that growth naturally in the market.
And how are you competing with index versus active? Like, how does?
Yeah, I think from my perspective, having visited, both of these worlds, active in the ETF space, active is a structure. It was a legal change that allows us to file products without having to tie them to an index. In the mutual fund world, it's a lifestyle. Like, it's the way that we manage our products. It's very actively managed, discretionary. So merging those two worlds and getting people to understand each other, I think is very important. When you look at the active structure, there's been stats stated earlier, 75% of the new funds are active funds. But I know our next panel is defined outcome funds, and there's a few hundred of those products just by nature of how they're delivered. And so, that could account for some of that 75%. My kids really like the movie Princess Bride, and that active word reminded me when, I think it was Inigo Montoya was looking at it, his boss or whatever it is, and he said, "You keep using that word. I don't think it means what you think it means." And I think across the ETF landscape, active can mean a lot of different things. Across mutual funds, it means a lot of different things. And if you put it on a plot, to me, it looks a lot more like a shotgun than it does an arrow.
Yeah. So John, as a new manager, and you're going to focus on active funds. How do you break into the market with active funds? It is a well-saturated market, as you mentioned. What's your secret sauce?
So we are new. We're going to be predominantly active. A lot of people ask us, why now? Isn't the market going to kind of plateau in here? It's if anybody looks at the chart, it kind of goes up and to the right. Our take is that the growth in the ETF market is going to accelerate from here for a couple of reasons. One, conversions. So we're going to see, and we have seen, significant conversions from mutual funds to ETFs. Secondly, just the tax benefit. If people are concerned with taxes, especially in the wrap space or in the 40X space, the SMA model's coming to this world as well, and the tax benefits in the SMA world with direct indexing and whatnot are a sea change, and is going to impact both the whole 40X space, both mutual funds and ETFs. We think taxes are going to become a significantly greater issue, and the weaknesses, I guess, if you will, of the mutual fund are going to be brought to light more and more. Thus, highlighting somewhat SMAs, but highlighting ETFs even more. And that doesn't even touch on the fact that the SEC may approve a mutual fund share class. So if that happens, we think it's gonna grow even faster. So it's a space we felt like we had to be in, and we think that with our investment capabilities, with Calvert's one of the leading ESG managers globally and has been net positive the last 2 years, which is incredible. Eaton Vance with bank loans, leverage loans, high yield and munis, and then Parametric, which has really led the direct indexing space. We think we have a lot to talk to clients about.
Wow. Marcel, State Street, unlike a lot of ETF providers, actually works with other asset managers. And, TOTL was mentioned, and SRLN, some really big names, Naveen, GSO, DoubleLine. What's the advantage there of partnering versus building your own?
That's a good question. So I think there's two things that spring to mind. So first of all, capabilities, core competencies, and then brand. And if you think about when we launched some of these funds, our Muni Suite, which is sub-advised by Naveen, today they manage $180 billion just in munis. So they are a preeminent brand in munis. And we launched some of these funds 10, 15 years ago. That may not have been a core capability of State Street Global Advisors at the time. Certainly, when we launched SRLN 10 years ago in loans, partnering with Blackstone, their brand in leverage finance, and both across the leverage finance spectrum, but specifically in liquid credit. And then, of course, we mentioned DoubleLine is practically a household name. And also the ability to bring to bear new and innovative strategies. So one of our newest partnerships with Blackstone is a fund that allocates both to loans, systematic high yield, and a little bit of a CLO debt kicker. It's one of the fastest growing strategies at Blackstone, and they've been able to bring it in an ETF. So those are some of the main reasons I think it makes sense to partner when we've certainly got this stable of best-in-breed sub-advisors that we work with.
Great. So we have some time left. I do have more questions, but we wanted to open up to the audience. Are there any questions? Okay, so I'll keep talking. So I always like to ask the question about, any best practices, because ETF, the market's growing, things are changing, in my opinion, for the better. But in terms of best practices in trading, choosing an ETF, what do you offer your clients? And Matt, why don't you start?
Yeah, I can speak from the product development side. Best practices for us when we have a product idea is, we'll put a sample basket together, meet with the market making community, come up with the best mix of product that not only solves a problem, solves our investment thesis, but delivers it in a way that's investable, that keeps our creation unit size as low as possible, and keeps our bid-ask spread as efficient as possible. And so we think that gives the ETF a really good chance of success in the market.
Good. Anyone next? John, David, Marcel?
Maybe I'll talk a little bit just trading best practices. That's kind of capital markets focus. One of the things we're often talking to clients about is just sometimes even the timing in the market. Looking out for the first 15 minutes in the day. Sometimes spreads are going to be a little bit wider during that time period as price discovery enters the market. So we have clients be thoughtful around that. Be careful around the auctions too. You might be a small size that isn't going to impact the imbalance greatly, but you're going to be included with every other order during that time period. So a large institution trades during that time, you could have some dislocation. So putting limits on your orders, even if it's a limit on close as opposed to a market on close, is something that we would recommend. The last thing, just related to fixed income, is just be thoughtful around some of the bond market hours. Naturally, there is some negotiation that will occur for products that have credit. So we'll do custom negotiated baskets for our credit funds, our aggregate funds that have credit. That will take some time. That's not done instantly. There's proposals that are offered by the liquidity provider. We're going to review those bonds that are put in. There might be some negotiation back and forth. There will be time there. So if you're trading, really late in the day, you might pay an extra few basis points for impact for certain products if the market maker is going to have to carry that risk overnight. So just being thoughtful around that, as well as bond market holidays. Columbus Day and Veterans Day are closed in the bond market, so you can't get out of your risk as easily sometimes in those days. So being thoughtful around that. And I said that was the last thing, but I'm going to add one more. The other one is call for help if you need it. It's something that we really try to stress with our clients. Most custodians will have a high-touch desk that will be able to facilitate more information that is usually available to the end client. And then the capital markets teams at your issuers, ourselves included, we're happy to help and just talk about a particular order, give some best practices about that particular asset type or when you trade that. That's, of all the roles that we perform in capital markets, nothing we like to do more than help our clients get a really good experience on a trade that they have. So don't hesitate to reach out to your issuer's capital markets desk as well.
And if I could just add a fun stat to that, since you mentioned Columbus Day. So $15 billion traded across the bond ETF landscape on Columbus Day, a day when the bond markets were closed, and that's about $1 billion more than the prior Columbus Day. But I think the markets were open this Veterans Day.
This Veterans Day, wasn't observed, which our bond team didn't even realize, I think, until 2 days before.
I would reiterate Dave's last point there for a second. If we're just talking about RIAs, most of their RIAs trade through their custodian. Talking to a custodian the other day, they said probably 20% of their RIA clientele understands that there's a high-touch desk. So if they're trading in a less liquid name, they're just going to float a market order out there. If it's not a deep book, it's not going to look pretty. And we're not happy about that. The client's not happy about that. The custodian's not happy about that. So it's really important, especially for the RIA community that trades through an intermediary, to get to know their high-touch desk. There are ways that you can code your trade so that it automatically goes to a high-touch desk. So if you are an RIA or if you trade through a custodian, make sure you learn those rules.
So, we have a question? Thank you.
I'll go first. How we built CVRT, which was a convertible bond ETF, was we thought about it as a fundamental rules-based strategy with an active edge. And so we built a category of high delta convertible bonds, which was very prescriptive. And then we've got our portfolio management team looking to hit singles and doubles around that. If there's a name they want to exclude, a name they might want to overweight, those are the active things and active bets that they're able to take. And then as a new ETF, one of the challenges is historical performance. And so one of the ways that we have looked to solve for that is by partnering with an index provider who can then take that rules-based strategy and build an index out of that. And then that index can sit over here. People can look at the high delta convert space to see how that might have performed historically. And then you've got an active fund looking to outperform and have an active edge on that.
If I could echo some of the things that Matt said, I think, for most of our AUM is indexed fixed income, and at State Street Global Advisors, we manage close to $600 billion in index fixed income. So, in terms of having that conversation and getting pushback around active fixed income, it's important to define what the parameters are and what that means, because active is a loaded term and it can mean different things in different asset classes or categories. An active ag manager can pretty much do whatever they want, and they are definitely not just trafficking in treasuries, corporates, and mortgages, which make up 92% of the ag. They're buying EM, they're buying high yield, and so many other asset classes. And in fact, some advisors don't realize TIPS are not part of the ag, for example, or high-grade floating rate notes are not part of the ag. Then you pivot to something like SRLN, our loan ETF, which is benchmarked against the 100 largest loans in the market. They're not buying EMD in that fund. They're not buying, mortgages. It's really a loan strategy that isn't forced to just buy the 100 largest loans in the market and can buy the next 250 and can maybe underweight some of them. So being active in different fixed income sectors means different things, and it's just, I think, important to engage with your clients and help them understand whether there's, more of a rules-based methodology like Matt described, or what the different levers are that the manager can pull, and what their constraints are as well.
We got the 5-minute mark here, so we can have one more question, or I can throw out the last quick question. So, speed round. David, recommendations.
Recommendations. You phrased it that
Product
way. I'm going to get in trouble for my compliance team. But I think really what we look at is what we're seeing in the future is we probably expect Matt asked the question or raised the hand on where we see rates go. I think it's going to be higher for longer naturally. And I think one of the toughest parts is really getting a feel, and everybody's kind of experienced this, have we reached that bottom for long term, for our long duration? If you look at flows, the number one product for flows through the first 3 quarters was a 20+ year treasury product, which will go unnamed since none of us traded it here. It's not our product, and where Rob is, Rob back there knows what I'm talking about. But when we look at that space, I think that's where we still end up with seeing BND as one of the top 3 flows, is because it still ends up being a place where you're not necessarily making a duration bet, you're not making a bet on credit versus treasuries. I think as a core part of a client's portfolio, it still has value. And obviously, I'm sitting up here from Vanguard, so of course I'm going to say that from a passive perspective. But I think we still see value there, and we still think for core assets in a lot of model portfolios, we'll continue to see kind of that passive ag for the long-term aspect of that. And we are not against active. We're going to launch a couple active products. When we think about active, we just really think low-cost active is important there. But we have a large active franchise, over $1 trillion in actively managed products, fixed income products in-house at Vanguard. So we see opportunities there naturally in the near term to find alpha on the edges of your portfolio with certain active strategies. And I think I did a good job of not totally answering your question, so I'll pass it to John. You
could have just said the ag. So Dave's the ag. John, what are you buying?
I'm not going to answer either. I think what's really interesting right now is the mountain of cash sitting in money markets. When the Fed does move, or when the market starts to think the Fed's going to move, I think that tsunami is going to be really interesting to see how it plays out. I think rates are going to come down a lot faster than people think once that happens, because there's just such a mountain of money. So I think you want to extend some duration. I think if you haven't started to extend some duration, I think you want to start extending duration somewhat now, because that has the potential to evaporate really quickly.
I think that the tools that existed 10 years ago in fixed income are remarkably different than what exists today. Like for 15 years, we were saying rates are going to rise, rates are going to rise. They didn't rise, and then all of a sudden they rose almost overnight, fastest and heaviest ever. And so I think the tools that are available today to build portfolios are almost 180 versus what was available 10 years ago. And if you follow the flows in the ETF market, almost 90% of the ETF AUM was built in a zero rate environment. And so when I think of it that way, I think it's an exciting time for fixed income. which I've never actually said before. So that's probably my recommendation.
Marcel, this has to be your favorite question.
Can I give tickers?
You can give tickers, whatever you want.
So I'm really excited about the Blackstone strategy I mentioned before. That's HYBL, high yield bank loan, or highball. Again, it's a multi-credit strategy. We talked about double line. I'm always impressed by that team, and that's TOTL, and they're trying to beat the ag, and they're certainly doing that this year. And then we have a partnership with MarketAxess, and that's LQIG, and that's tracking a liquidity scored version of the 400 most liquid investment grade corporate bonds. So I'll end with that.
Great. Thank you all. Thank you very much, and have a great day.